please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You know, it continues, I think, for some of those hotel stocks. By the way, Reliance Infra, the promoters release pledge on around 11 lakh shares on Jan 2nd to 4th. So that's good news. I think just a short while back, our ticker team had, flashed that on Rel Power as well, there was some release of pledge. So it appears that all those pledge shares for the group are getting released, and I think that's why the stock is seeing a bit of an uptake in the last few minutes. Keep an eye out though on some of these hotel stocks. EIH Associated Hotel, we don't really talk about that stock, but normally there are not very high volumes, but EIH Associated Hotel, that stock as well, volumes are picking up, it's moving higher as we speak. And Mandana Retail, it's been one of those big, that's EIH Associated Hotel as well. I think it's the group company. Both those two stocks are moving higher, so we should get that as well up for you on the screen. And Mandana Retail, I remember the promoter joined us last month and said that in fact December month is a good month because it's the end of the year. You have Salman Khan's birthday as well, who's their brand ambassador, and that one as well, after being a big underperformer, suddenly that moves to the high point of the day. So keep an eye out on a couple of these stocks. IDFC Bank, that's from another banking stock that's been buzzing around, and today as well is doing well, Surabhi.
Absolutely. So it's hotels, and otherwise, I mean, as long as you have carbon in your name, I think these days it doesn't matter. The market isn't even going beyond asking what's going on. I mean, one more stock is now coming on the radar, Oriental Carbon. Anyway, Goa Carbon came out with great numbers. We've seen that, and you were in conversation with the management. So it's good performance, I guess, but I think the market is not even going beyond some of the names on this side.
You know, that's a good point, Surabhi, because, you know, at one point in time, people were mistaken Oriental Carbon as a carbon play.
Exactly, because it's Philips Carbon and it's Goa Carbon, so there'll be Oriental Carbon.
So we are on CNBC TV, we alerted our viewers first, Shuni, that it's insoluble sulfur, which is used when you make tires, you know, so that's in fact, you know, I'll just have to say that we had alerted our viewers on Midcap Mania. At that point in time, the stock was some 600 rupees approximately. So it's had a good run in the last 1 year or so. And it's got nothing to do with carbon, but that's the market for you today.
That's the market, yeah. Very important caveat that Nigel has put out. If you're listening, Oriental Carbon doesn't make the same stuff that Goa Carbon makes. Please keep that in mind. It's a different play. It's on sulfur. It might have its own triggers. Just important to keep those pieces of research in mind. Well, let's move on then. Now, Yash Jain, our colleague, caught up with Rajiv Agarwal, MD and CEO of Essar Ports. He began by asking him what the expansion plan is at Vizag and what this would mean for the company in terms of the revenue targets going forward.
We have seen robust growth this year, so we will be growing by about 35% in terms of quantity handled and also revenue. So from about say 30 odd million, we will be about 42 million tons of cargo. Next year we are expecting, because these two terminals which we just mentioned are coming on stream, so we will expect it to go to about 60 million. So that will be another growth. In terms of EBITDA, we have very robust growth again, from 80 million to 140 million this year, and from 140 to about 210 million next year.
If we talk about a slightly longer time horizon, maybe 2 years, what is the kind of expansion which you are looking at? What is the kind of investment which Essar Ports has earmarked towards this particular expansion?
So in terms of organic growth, we are expecting that we will invest close to about 500 million in various projects that we are looking at, which are going to be fueled by internal accruals and commensurate debt from the banks, who continue to be very happy with us because of the good performance of the company. So we are looking at expanding in all our existing locations, and also maybe look at 1 or 2 projects other than that on a greenfield basis.
As far as the debt levels for Essar Ports are concerned, help me understand to what point did you bring it down post the Vadinar transaction, because of course that was also used to bring down debt, and would it stabilize at the current point, or would you look to reduce your debt further through various means going forward?
So we had a debt which was close to about $1 billion in the business for an investment of close to $2 billion. So now after the divestment of Vadinar, we are around 500 million. And our EBITDA is going to be about 200 million next year, 140 million this year. So we feel that it's a very healthy 3:1 EBITDA to debt, which is extremely healthy for infra business. So going forwards, I think if we see by next year, it will be 2.5 times EBITDA.
Let's get you some big voices on the market now. Things have never looked better from the Indian macro perspective. That's the word coming in from the top team at Deutsche Bank India. They add that the headroom for growth is unparalleled in the country right now. Here's a slice of the exclusive chat we had with them earlier in the day.
It's very difficult to look at valuations in isolation. If you look at India in its entirety at the moment, I think from a macroeconomic perspective, things have never looked really better. There's a lot of stability, a lot of resilience. And we think that the prospects going forward also look very, very good. So you could say that the markets have really run up, but a couple of things that you need to bear in mind with respect to that. First and foremost is that a lot of the structural changes that the government introduced haven't really paid off yet, and so the upside for that is significant. Then you're seeing growth, globally, and then you're seeing, a lot of, liquidity internationally. All markets seem to be, doing exceedingly well. And when you look at the headroom for growth within the large economies, I really don't think there's another economy out there which, compares favorably with India. So whether we take the view globally or within the country, I would say that this is one of the markets that we'd, put as one of our top picks. Absolutely.
Okay. Pratik, morning. Come in on this because, the views are positive, but the Nifty target that you guys have for the full year of December 2018 is 11,500, which is not too far away from here. Are there any concerns?
Well, I guess the concern is really valuation. The markets have already front-loaded a lot of the earnings expectations which are coming in. Remember, we had a 30% return on the Nifty last year in dollar terms, and that was one of the best performing, India was one of the best performing emerging markets globally. But having said that, going into 2018 and looking into FY19, this is the year when we're expecting earnings recovery, corporate earnings recovery, which we haven't seen for the last 4 or 5 years. We've seen earnings growth more in the single-digit range. After a very long time, we'll start seeing double-digit earnings growth, but the valuations have already gone up quite a bit. Now, on the bullish side, one can say that, look, this is the phenomenon globally. Most asset classes, including equity markets globally, are at high valuations. But in India, we went up despite relatively weak foreign flows. It was largely driven by domestic flows, which we expect will still remain strong. So while we are expecting a strong cyclical rebound in the economy as well as in corporate earnings, a lot of it is already priced in. So that's why return expectations have to be moderate. We cannot expect the same 30% kind of growth in the markets once again in 2018 in our view.
Rahul, what I wanted to ask you was that all through the last 3-4 years, it was the macros that were strong, and it was Pratik who was not delivering, in the sense the micros were not delivering. But now, I mean, how are you looking at the bond markets? Already, we touched 7.4, chances of global inflation and domestic inflation picking up. So where is this yield for 2018?
See, there are two aspects to the whole bond market or the debt side of the business. The rope is slightly tighter this time compared to a year ago. RBI has to balance the whole concept of fiscal prudence that the government is going to show or not deliver. And the other sensitive factor that has come into play is oil. We didn't anticipate oil to rebound to the levels that it has touched. We don't yet know whether it will continue to stay at 70 or rebound back to a sort of lower level and settle at that. I think that's the one aspect where the government has to follow, and RBI will therefore look towards that as an indicator to see whether the rates need to be hiked up or not. And the other aspect is fiscal. Yes, in the longer scheme of things, there is growth, and the macro has to sort of be delivered, and you're getting into a era where I think after the two sort of shocks of demon and GST, you should not potentially have another situation where growth gets impeded by a rate hike. But markets are already factoring, as you rightly said, about a 40-50 basis points over the next 15 months. But I think it's the fiscal that will first, and the oil as step 2, which will decide whether there is scope for a rate hike or not. Because effectively on a real interest rate aspect, if you look at it, with the inflation sort of expected to be in the 4.5 on a sort of 12-month basis, and repo at 6%, you still have 150 basis points real interest rate. So which is something which RBI has felt comfortable in the past with.
So you're saying that you wouldn't pencil in a rate hike in the current year?
I think the guidance, no, I'm not saying that. I think the guidance this time around is not that straightforward. It'll be a function of where the fiscal goes in terms of the guidance for 2018-19 and oil prices. So this time it has to be a little bit measured from that aspect. But really the growth is an important aspect for the economy, and we are still not at the levels that we should be for inflation to become a bigger worry than from a growth point of view.
No, I just want to tie you down to a number. Can you give me a range for the 10-year for the first half at least?
We think that, depending on how the budget, announcement happened on 1st February, you could see a range which is, potentially, I would say about 25 basis points up or down from here.
Let's talk about sugar now, where the prices have continued to decline, down 10% actually since the month of October 2017. And there is no respite really, because while on one side we are looking at higher production, the other side it also is about the kind of demand estimates that the market are working with, which is not so high right now. And that is what has led to an ISMA meeting with the Food Ministry to discuss the sugar price decline and of course the kind of measures that can be taken. Abhinash Verma, DG ISMA, now joins us to talk more about that. Abhinash, hi, good to have you. First of all, what was the meeting about? What is the outcome? What can the markets expect?
The meeting was more to review the sugar situation. We are all aware that this is a very balanced demand-supply situation. We started the year with a very low opening balance, and the demand-supply position is so balanced that the sugar prices should not have actually fallen. So it was more out of fear about 2018-19 sugar season's production that people are talking about, which we thought was too early. And that is why the government had a meeting with us to find out ways how to control the falling prices.
Avinash, also, while of course the import duty stands quite at high, there still is a fear. Do you look at import duties being hiked from here? And also on the other side, what are the export numbers or the export duty measures that are in the pipeline?
Talking about the import duty, the current import duty is at 50%. As per a WTO agreement, the import duty can go up to 150%. Oh. The Customs Tariff Act allows it to go up to 100% straight away without any amendment in the Act. So the Finance Ministry can increase it from 50% to 100% any day within a day's time that they want. There was talk about Pakistan government and the state government of Sindh giving some kind of an incentive on the exports from Pakistan. But in the last couple of months, only 2,000 tons of sugar has come in from Pakistan to India, and that too, I believe, is under losses, and it's still not come into the market, still in the warehouse. Now, with the fear that the government can increase the import duty to 100% any day, we do not think that any trader in India would like to bring in sugar from Pakistan, considering that they might lose money. So that fear is not there. But nevertheless, we have requested the government of India to increase the import duty from 50 to 100% because they also believe, they also agree that we don't require any import whatsoever. So that might happen. It is under consideration. When, I can't say. Secondly, on the export front, we are not having any surplus sugar in the current season. The earliest that we can imagine or think about any surplus is December 2018. That's almost about 11 months or 12 months away from today, sure. When the new season starts. But whether we are going to have a surplus or not, we can make an estimation only in July 2018.
Also, what is your sense on prices right now? I mean, of course, earlier we saw government's comfort level at 40 rupees per kg, and they were trying everything to keep the prices there, ensuring that they wouldn't rise from there. Now that the prices have been declining, it really has turned around on the kind of measures that they need to take.
If you really look at our cost of production, the all India average cost of production would be about 35, 36 rupees per kilo. It would differ in different regions. The current all India average is lower than that, about 33, 34. So some people are losing money. Some people would be kind of not be able to pay to the cane farmers, and that would be concerning the government. And that is why all these meetings. The fear about 18-19 has come about slightly early. It's more a theoretical fear, it's more a guesswork, and that is what we need to actually take the fear out of the market, that 18-19 production might get adversely impacted if the rainfall is not there, if the rainfall is not good in the concerned regions in July, August or September. So therefore, if the fear out of 18-19 is taken away, number one. Number two, The government has almost assured us that in the last 3 years they have been supporting the industry, and they will continue to support. And if we are able to find a market in Bangladesh and Sri Lanka, almost all the surplus that we can expect in the next season can go into Bangladesh and Sri Lanka, which will ensure that there is no surplus in the country. And that is what we are looking forward from the government.
Okay, all right. Thanks so much, sir. Thanks so much, Manisha, for joining in fact, giving us that quick update. By the way, just pull up the intraday chart of Prakash Industries. Those numbers look very, very good. And I'm just looking at the forward guidance that the management is giving us. They said that, in fact, earlier the margins were at around 12%. It's increased to around 17%. Now, in the last quarter, it's moved all the way to around 21%. And they're expecting 25% in Q4 FY18. So keep an eye out on that stock. It's doing well. It's spiked up. It's been a four-bagger. I remember Mr. Tulsian was very, very positive on the stock, right from, the sub-100 levels on. And from there, it's more than doubled your money. So keep an eye out on that. Those numbers look good. And importantly, the forward guidance as well is very, very positive. They're saying that, in fact, the margins are going to improve from here on. Well, on that note, what we'll do is we'll wrap up on the show. You stay with us. Business Lunch takes all the action forward.